Welcome, everyone. By way of introduction, I'm Audrey Senekal de Wet, the Executive Editor of Independent Media Business, that is Business Report, which I fondly refer to as BR, and Personal Finance. BR is a supplement in the Star, the Pretoria News, the Mercury, and the Cape Times. We also publish content in all the other independent titles. Our topic today is trusts and tax. Is mine, still mine. On our panel today, we have Fia van der Spy and Willem Oberholzer. Fia is the founder of TrustEase and a regular contributor to Business Report and Personal Finance. She's also a chartered accountant and has several degrees, such as a master's degree in local and international tax. Willem is the CEO of Probity Advisory and the director of Kristen SA. Willem has more than 21 years professional experience in income tax. I have to admit that I don't know as much as I probably should, so I'm looking forward to knowing more. I would like our audience to ask questions during the webinar, which we will post to the panel after their presentations. And yes, the presentations and the recording will be available after the webinar. So, Fia, without any further ado, let's kick off with you. Tell us what is TrustEase all about and why is it important to have a trust? And please share some of your stories with our audience. Thank you. Over to you.
Thanks for the opportunity, Audrey. I have got bad news for people who are joining this conversation to find a yes to the answer in terms of is mine still mine. Have very bad news for those people. Now I just need to find sorry about that, my presentation. I hope everybody can see it.
Yeah.
So is mine still mine? The answer is no. So for those who wanted a yes, can probably log out now. I think a lot of misconceptions and what's contributing to mismanagement of trust is really a lack of knowledge, a lack of educating clients in South Africa. So I think when we start looking at a trust, it's very important to understand what a trust is, what a trust can do. And if you don't understand that a trust forms only a part of your estate planning, then you're starting on the wrong track. So a trust really, comes into a discussion when you actually look at your estate planning. And estate planning, when you look at the definitions, it includes both planning your estate during your lifetime as well as for when you're no longer around. And then you get the different forms of trusts, depending on whether you're creating a trust only upon your death in your will, which is called a testamentary trust. It's often used for minor children, or you can create a trust during your lifetime. So as you can see, a trust really forms part of a whole conversation around your estate, around your wills. When you look at your succession, it's very important then to figure out where your trust fits in and actually set it up accordingly and manage accordingly. Then once you've made a decision as to are you creating a trust during your lifetime, or only upon your death. If it's happening upon your death, you would obviously cater for that in your will. So the will terms would actually form the terms of your trust, versus you are creating a trust during your lifetime, and then you can actually start appointing your boards of trustees, get your affairs in order. You can typically use that for asset protection during your life. So there are benefits of creating a trust during your lifetime. So whatever you do, as I said, the starting point is to do it as part of your estate planning. So the whole idea is to leave a legacy of love and not an absolute mess upon your death, where your descendants have to run around, find out, where the assets are, have to end up selling assets to just pay the estate costs and taxes. So I think once you actually do estate planning, it's really what you want to do to actually achieve that legacy of life. And I think from my point of view, I think that's the overriding, question as to, why you're setting up a trust. The very important thing to bear in mind is the founder has to divest of the assets. He literally gets rid of it. So it's moving from his personal estate into the trust. So hence my quick answer to is mine still mine? It's absolutely not. And you have to demonstrate in terms of your documentation, in terms of the way you set up the trust, that you actually have divested of those assets, and it no longer belongs to the founder. And also important is one just has to remember that sometimes when you set up a trust, the trust obviously doesn't have money to buy these assets. So that loan account that you create when you actually sell these assets to a trust actually still forms part of your estate. So from an asset protection point of view, you actually want to start a trust, when you're going to be rich one day. Because the moment you've already created all these assets in your personal name, it's very hard now to move it into a trust. With the attack of SARS now on interest-free loans specifically. So just be mindful, that asset will remain an asset in your estate, being the loan that you sell the assets to the trust. So when we look at why a trust is such a unique monster, I think the overriding principle is that we have to achieve a situation where we are distinguishing between the ownership and control of these assets that we transfer into the trust versus the enjoyment of those assets. And a lot of South Africans just can't get this right. So you want to say mine is still mine. Yours can't be yours, because when you look at the ownership and control, you have a board of trustees who now decide over what happens to these assets, what must be done to these assets, and the board of trustees then decide over the enjoyment of these assets that go to beneficiaries. So when you look at the ownership and control, it is now a requirement for new family business trust, the master definition. We have to have independent trustees. So you have to consult others now. So you cannot override others. Be careful for terms in the trust deed to try and retain control for you. So I use the famous term of we can try in the trust deed to achieve a level of influence. I don't think that's control, but it's a very fine line. But be very careful when you try and write into the trust deed that you want to control these assets that you actually divested of. Why is there such a mess in South Africa? So in South Africa, there's about 850,000 trusts registered, about 300,000 are registered with SARS, and only 80,000 submitted tax returns. So you can see on the level of compliance, we are on 11%. When you speak to the legal fraternity, they would tell you that 90% of the trusts in South Africa never came into existence because of bad drafting. Because the trust service providers like the copying and pasting exercise. So, through that, come a lot of, invalid clauses where we end up with a trust that's not even valid to start off with. A trust is definitely not similar to a will. A lot of people think you draft your trust deed, you put it in some bottom drawer and forget about it. A trust requires active management. A trust is also unique from a perspective when you compare it to a company. A trust is not a legal entity, it's just an accumulation of assets. And the legal fraternity call it a contract. So your trust deed becomes your contract, where the different parties, being the founder and the trustees in the beginning, agree to act within a certain set of rules, and the trustees have to follow those instructions, and they cannot do anything outside of that contract. So I keep referring people back to the trust deed, because you're going to find the powers there that the trustees, what they can do and what they cannot do. And you unfortunately cannot move beyond those powers that the founder has given trustees when he registered the trust. Trustees are also the custodians of assets as joint owners of the trust assets, and that requires joint action. So I'm not going to go into that, that's a discussion for a whole day, but basically it boils down to the courts are saying all trustees have to participate in trust decisions. So the assets that you moved into that trust, you cannot be seen to be making decisions and overriding other trustees or excluding other trustees. A lot of people rely on the majority decision rule in the trust deeds. That's not going to take you very far. The courts are saying every trustee will at least participate in decisions. And every trust is run by resolution. There are a number of court cases, which is very unique to a trust and very onerous. And along with that, we have to retain documents for 5 years after the termination of the trust. So it's not similar to SARS, where you've got a rolling 5-year cycle. You keep trust records till the end when it terminates, plus 5 years. I attended a webinar in the week where the presenter said they recently had to provide documents as far back as 1951, where the courts required that. So I know a lot of trusts that have documents so far back. When we look at SARS, it's a completely different matter when it comes to trusts. Each trust, the asset inside the trust is treated as a silo. For example, we have 5 properties in the trust. Every property is treated almost on its own, and its tax follows the property with its related income and expenditure. You cannot mingle. So it's very important when you look at record keeping that you can treat each asset as a separate silo. There's an interesting concept that SARS uses, connected persons. They want to know every transacting person, with it. You need to keep a record thereof, and SARS is after the family members and the connected persons as SARS defined, and they have now extended those connected person rules, where typically you have interest-free loans, you do transactions at non-market related interest rates, non-market related prices. So it really becomes problematic, and SARS, got their eye on the whole connected person issue. Also, the attribution rules. We'll have a look at it later, and Willem will probably also speak about that. There needs to be a link between an asset and how it was acquired. So if the founder, pushed all his assets into a trust, all income generated from that will be imputed back to the founder to get around any anti-avoidance and to stop people from abusing the trust form. So attribution rules are unique to a trust. And then distributions of income, you may have heard about the conduit principle. The conduit principle allows you to distribute income and expenditure to beneficiaries. And coming back to treating things in a silo, you can distribute net income on a particular, for example, a property. So that's also a unique principle to trusts. Even tax is unique for trusts. Not a lot of people know this, but a trust is a taxpayer of last resort. You often hear in the media people speak about a trust is, it's expensive, and a trust pays the highest tax, 45% for income tax and 36% for capital gains tax. It's double what individuals pay. Very few people know that a trust is a taxpayer of last resort. I've just spoken about the anti-avoidance provision. So firstly, SARS would look at loans that are made below market-related interest rates, and would then impute that income back to the funder to the extent of the low interest rate. And we can use the conduit principle, so we can push all the tax obligations down to the beneficiaries before the financial year end, and then the beneficiaries can be liable for the tax, and only then whatever remains in the trust, the trust will pay taxes on. So you can see it's a very different way it's been treated. So trust is quite a scary thing if you look at how unique it is, how different it is, the complicated tax treatment. And that's how Trustees was born about 8 years ago. We met a lady whose dad had 5 trusts, typically these complicated trust structures. And her dad died suddenly, and basically the business partner stole 50 million rand out of the trust structures because he knew the trusts weren't kept up to date. So, we then started a process where we can help families to protect their assets in the trust and help prevent abuse. So, yeah, trust is not for the faint-hearted, but I just want to show you a couple of rules that as long as you stick to those rules, you should be fine. So the big word that's thrown around in the trust fraternity, the whole concept of an alter ego, it's something that the courts just do not allow. So that means a trust is just an extension of yourself. For example, I think mine is still mine, and I treat the trust assets just the way I wish. I disregard other trustees, I disregard the trust deeds, I make decisions, and I inform the accountant, just make this happen. I bought a house, I sold this. So if you treat the trust assets as if it's your own, you may undo the entire benefit of creating a trust in the first instance. Now, there's a clear distinction between an alter ego trust, because that does still exist. So the courts would just take into account, the trust assets. For example, in a divorce case, they would take into account the trust assets in a settlement agreement. The trust still exists and would exist after the divorce, versus a sham trust that just never came into existence. You never had the intention to create a trust. So those two, very different concepts are important. But especially families have to be super diligent and be very careful of little things that they may not do or may do that may lead them to the trust being labeled an alter ego trust. We want to avoid that. I just want to show a couple of pointers in terms of what you have to do. What does it mean? What you have to do to not be labeled an alter ego trust? And it's really not very complicated things. So firstly, as I said, I always send people back to the trust deed. Have you read your trust deed? Do you understand what the trust deed requires? And a lot of people are not technical people, and some trust deeds are really intimidating. So, for example, in our system, we have built, trust deed parameters that guide you in terms of what you can do and what you can't do in terms of trust deed. It just helps with control, and we need, for SARS and for creditors to prove that, we acted in accordance with the trust deed. For example, if you're not, the bottom one, you're not allowed to let property in this particular trust, we would unclick it. It would not, bring about the resolutions to let property. So if you let property and your trustee doesn't allow you, that transaction would be null and void. So it's very important to keep referring back to your trustee in terms of what you can do.
Fia, just sorry to interrupt you. I'm getting already a lot of questions, but one of our audience members just asking that you can please explain a little bit slower. They are so keen. So
you're going too fast.
They are drinking in everything that you are saying. So if you don't mind, just take a deep breath.
I've got so much to say. So
I know, don't worry, you've got ample time. Good.
Okay, so and a very simple thing that most people forget about, you have to have a separate bank account for every trust. So the moment you register your trust, you have to open a bank account. Once you've got the bank account, then we register with SARS, because SARS recognize a trust now as a person, and it has to submit tax returns. So you can see it's definitely not similar to a will. So you have to make sure that all transactions related to the trust happens in the trust bank account, and then you do your allocations from there. So that's a very important point, and it's a very easy one where people can start labeling a trust as an alter ego trust. Okay, I've spoken about the separation of ownership and enjoyment. We have to just demonstrate that. So what do you have to do to demonstrate that separation and adhere to the joint action rule where all trustees have to participate? We have to be very careful in the manner that we communicate with your fellow trustees. You can't just write them an email and say, I've bought this house, sort out the paperwork. For example, if you've got a corporate trustee as one of your trustees who's typically doing your administration, you could never instruct them to do anything after you've just performed an action. So do the compliance first. It's very hard, and South Africa is famous for it. You just carry on as you wish. One day you do the financial statements, and then you just reverse engineer and you get your accountant typically to go quickly populate all the resolutions. So now what happens if somebody, one of the trustees pass away during that year? Then you're sitting with a big problem. So do the administration first and, get that discipline. Once you've actually, done the administration, then you can actually, let the cash flow. So, we use DocuSign, it's very simple. You find easy ways to make sure that you comply and do the administration first before any cash flow. A very important issue as well is keep minutes of meetings. That's, as I said, would be one of the issues where they're going to catch people, because in your trust deed, you often have the instruction from the founder and part of the terms of the trust deed where they say the trustees would have at least one meeting a year. So it's going to be easy for a creditor or SARS to turn around and say, show me those minutes. So have you had your meeting every year? If you haven't had that meeting, or you can't produce minutes, then it's going to be problematic. So the onus is going to be on the trustees to approve. So they would make the allegation, and then the onus is going to be on you to prove. So very important to keep minutes of every meeting. Firstly, have the meeting, but we often see where trustees had meetings, but they just never finalized the minutes. So, we have created a digital meeting room where we send out the agenda beforehand digitally. On the day of the meeting, we record the physical meeting, because often there's conflict between the trustees as to what exactly was discussed. And then we finalize the minutes straight after the meeting. And I think that's important to just make things easy and, make sure you comply at all times. The moment people, postpone to do things, then it just never gets done. I mean, we know we're all busy. Another requirement from the Trust Property Control Act, Section 11, it's old wording, but the modern interpretation of Section 11 is every trust has to have an asset register. I mean, do you have an asset register? I haven't found one trust with an asset register until, we ask for it, and then the accountant quickly produces it. So that is, legislation. So it's required to have an asset register that speaks about a description of the asset, when it was acquired, and the location, and so forth. So, and then another important thing is keep books of account. That's, what trustees have to do. And the books of account, doesn't mean financial statements. A lot of clients think, and I've written an article, for Audrey the other day, where I said financial statements does not demonstrate trust compliance. You can see it's all about administration. It's not about the numbers. So you need the information, obviously, to submit to SARS, but it's very important then to keep books of account. And I think also in trust-specific terms, have things such as beneficiary statement accounts, connected person transactions. So report what you ought to report on a trust specifically. Do you know who connected persons to the trust are? I don't know how, accounting packages can, at the end of the year, establish connected persons kind of retrospectively. A lot of times, as I said, family members are doing transactions with a trust, definitely not market-related terms. So SARS wants to know about connected person transactions, and because SARS extended now, so a connected person of a connected person of a connected person can now be a connected person in relation to the trust. So it becomes really tricky to kind of plot these people. So our system has got a way to from the beginning label those people. And as I said, we need an ability to keep documents for 5 years after the trust termination, every single document related to the trust. So I think it's very important to have a central repository where all trustees can log in and view these and contribute and make sure all the documents are kept up to date, and then obviously for the retention for 5 years after termination. So you can see it's actually not that difficult. As long as we follow a couple of simple steps, you can leave a legacy of love. So we have also written a book to really make it easy for trustees and estate planners to just understand what to do. Because often when you read, technical handbooks, you just still can't figure out, what you have to do. So, our book is a easy manual to refer to and to know practically, what's expected of a trustee typically. Thank you, Audrey.
Fia, there's a lot of questions streaming in, but I think let's handle those questions at the end. Willem, over to you. So, tax is mine, still mine.
Yeah, you see, Audrey, I should never have said it's mine, still mine. Shows you, ne?
Yeah,
So,
it was you that with this topic.
Yeah, no, that's true. So just a little bit background on Probity. We was started about 8 years ago, and it's really a boutique firm that started out of handling tax arbitrations and disputes. So background on me, all the degrees that goes with the CASA, with the MCOM, registered tax practitioner. I'm a trustee, I'm a director, I lecture at the University of Pretoria. I'm a tax advisor, tax risk management, a fraud investigator for SARS, and I do tax planning for the taxpayers. So I do know the devil that you don't. And then clients that I've served over my last 25 or 22 years, couldn't know how many it is. Ernst & Young, Danone, Italtile, the Industrial Development Corporation, Foscor, National Road Agency, MTN, and Discovery. And that's where I spent my 20 hours or my 20,000 hours to really just understand this animal that you call tax. And you can ask me the trick question later, Audrey. I don't mind. I think I've got the answer for you now. And as Fia said, there are a trust has to have certain elements to it to work, right? So the founder has to have a very serious intention to create the trust and to transfer control over the administration and the management of those assets. If you don't, you run into, like she said, the alter ego principle, undue influences. Are you really, and do you have independent trustees on that trust? If you transfer assets, be careful. You know, the Income Tax Act is one section that catches it all, and then there are about 100 odd sections that deals with it. But what if? And one of them that's included is donations. Now, and I'll give you an example of a donation. There was a court case where an individual transferred his property into a trust to effectively take over his maintenance liabilities for his children in a divorce. SARS seek to attack him on the principle that he made a donation on it, and he won the court case because the trust assumed his liability for the future maintenance payments. So he effectively sold that the trust paid for the property by assuming a future liability. There was no disposal, there was no donation. He wasn't being gratuitous in nature when he did it. And then I think Fia also touched on the connected person rules. A connected person in relation to a trust is any beneficiary of the trust, any family member within the third degree of contiguity in relation to that beneficiary, as well as any company that is considered to be a connected person in relation to a trust. So let me explain it to you simply. If a trust owns more than 20% of the shares in a company, the individuals who are the beneficiaries and the company is connected parties in relation to one another. And if you cut through all the jargon and all the fine print, here's a golden rule of advice. If you do a transaction with a family member or a connected person or a trust, you do it at an arm's length price. If you don't, you are opening yourself open to scrutiny and attack. Like we said, there has to be a trust deed. Fia quite correctly said that a trust is not a separate legal person. The legal persona of the trust vests in the trustees as in their individual capacities. The trust property must be clearly defined, and I agree, the trust asset register is of critical importance. The objectives must be clearly stated. There must be a binding obligation on the trustees to administer the trust properly, and it has to be run trust stricto sensu. You have to be held accountable for what happened to those assets in the trust, and there must be a beneficiary in the trust. So the obligations in relation to the finances of the trust, you have to have your trust deed in place. I'll quickly discuss that. You need to have administration in the trust, your financial records, and your trust must have a bank account. And we in South Africa, the real thing is mine still mine. People run a trust as if the assets are still theirs. And this is where the tax problem comes in. So a trust deed needs to be in place, and let's handle this one quickly. The purpose of the trust will define whether that trust is effectively conducting a trade. If the trust is set up for benevolent purposes, please explain to me how it's a trade and how it will ever qualify for a deduction in terms of 11A in the generation of its income. So you need to spend time and understand very well why you're putting this trust in place. The administration, I think Thea covered that. Let's leave some more time for discussion at the end and questions. The accounting records and the financial statements, accounting records. Keep your supporting documentation, the trust minutes, the resolutions, and the authorizations for payments. The horror stories I can tell you about payments out of trusts and one trustee having de facto control over the monetary assets of the trust creates a very significant problem. And then your trust bank accounts, I think Thea also touched on, so we can skip that one. Compliance with legislation. You need to comply with the Income Tax Act, the Bank Act, the Value Added Tax Act, the Financial Institution Act, the Prevention of Gambling and Corruption Act, the Financial Intelligence Act, and then you've got the Tax Administration Act. So please make sure that when you have a trust in place that you have qualified trustees to run and help you administer this trust. And I'll explain it to you this way. Will you give the keys to a Ferrari Mondeo to a 12-year-old child? No, you won't. So why, explain to me, would you put your assets that you want to leave as a love legacy to unqualified people? Unless you retain control over those assets. Overcome that hurdle. I'm clicking and nothing's out. So the conduit principle. The conduit principle really means that a trust's income never loses its identity. So if it's rental income flowing into a trust and the income is vests in the hands of the beneficiaries, that will be rental income in the hands of the beneficiaries. So too will the expenses in relation to those or vesting of the income and the expenses. Just an interesting point. You can never distribute a loss out of a trust. So be careful of that one. And any transactions that you do with a trust, and I have seen weird and wonderful things in trusts over the last 20 years, but bottom line, Section 7C of the Income Tax Act really brings everything back and says, if you want to make a loan to a beneficiary or you make a loan to a trust, please make sure that those loans are interest-bearing at the official rate. The official rate is 8%. Let's assume your tax rate is 40%, give or take. So let's say that you'll have a marginal tax leakage of about 3.2%. That's a lot better than a 200% tax avoidance penalty. And then the taxation, the distribution to the beneficiaries are taxed according to the nature of the beneficiary, whether it's a natural person or a company. In other words, and that's where Thea said the trust will always be the taxpayer in the last instance or in the last resort. And then, so a trust will always, for income tax purposes, have a tax year starting on the 1st of March and ending on the 28th of February of every year. A trust has a tax rate of 45%. That would mean that any income that is retained in the trust and that is not taxed in either the hands of the donor of the assets or the beneficiaries will be taxed at 45%. So the trust is taxed on income that is retained in the trust, i.e. not distributed to the beneficiaries, provided that the assets are owned by the trust, that the income it relates to, and that the beneficiaries has a vested right to, and no beneficiary has a vested right to that income. And when will you tax the donor? When the donor has or still owns the assets that is purported to be owned by the trust. That income will flow to the donor unless the income has been vested via the trust in the hands of a beneficiary. Capital gains. The tax's inclusion rate is the same as that of a legal entity or a company, taxed at 80% at the inclusion rate, which means if you apply 45, you get a net effect of 36% capital gains tax payable in a trust. So the trust is taxed on a capital gain only if it's not vested in the hands of a beneficiary. And here's something that I've seen gone horribly wrong over the years. A capital gain can only be distributed to a capital beneficiary. And in very limited instances, and with very careful planning and thought, can a portion of a capital gain go to an income beneficiary if he was prejudiced in the past. The donor will be taxed on the capital gain if he still retains the asset or ownership to the asset, and there's no beneficiary has a right. And then the last instance, and this is usually what happens, is the capital gains are distributed to the beneficiaries, so it will be taxed in the hands of the beneficiary. The inclusion rate of the beneficiary will be applied, which is 40%, and then taxed at the sliding scale brackets. So the golden rule from a tax perspective is A, get your tax administration in order. Nobody can stress the critical importance of this. And then please, Superman had an alter ego. His name was Clark Kent. Don't be your trust's alter ego. Run it like you would run a company, and how you would run that company and those assets through the trust, that you have to count for your children how you squandered the money and the assets. If you bear that in mind, the alter ego kind of goes away, because you assume a fiduciary duty for those assets that you look after in the best interest of those that you want to leave it to. And that's why you should have set up that trust. And that is really the tax implications of it. And if I have to summarize it really, Audrey, it would be, if you get it wrong, you're in for a very big hiding. If you get it right, it works. Can't explain it more clearly than that, really.
Thank you very much, Willem. Are you done?
Yes, I am.
I don't know if you can see me.
Now you have disappeared from my screen altogether.
So, yeah, I don't know what to do here to get my... let me try again. Wow, I think... I don't know what's the problem here. Okay. Whilst you can't see me, I've got a lot of questions. As long as you can hear me, that's all good. I think, Theo, you might have also received some of the questions. The first one was from Lebo, which asked, how much does it cost to open a trust? I'm just going to put the questions out there because we're running a little bit out of time. And Michael asked, please explain a special trust. And then Paddy asked, if there is an amendment to trust deed, which is registered with the master, is it necessary to draft a new revised trust deed? And Chris is asking, when does a trust legally terminate? Zahn is asking, how can I amend the trustees of a trust we no longer have access or contact with the trustees? And Phil Eunice asking, please explain the difference between an interview and a testamentary trust. And there's a lot of other questions, but I think that's a mouthful. So if you could maybe share that between you and Willem. I don't know who wants to go first.
I think you are muted.
You are muted, yeah.
Am I back?
Yes.
Okay, cool. Sorry. In Afrikaans, if I can start with the cost of a trust. In Afrikaans, we've got a saying, goedkoop is duurkoop. I don't know what's in English, but basically buying something cheap will cost much dearly later on. So yeah, I don't think it's something you're going to shop around to get it as cheap as possible. I think you need to find a trust practitioner that can do a proper quality job and then get that at the best price. So it could anything, I know a lot of people charge even from 2,000 up to 20,000, you get some really expensive trusts. That's also not necessary. But I think it's more about quality and comfort that, the trust practitioner makes the effort to, tailor the trust deed to your personal circumstances. The moment people just, replace your name and your ID number and the name of the trust, you should run for the hills, because that's a 2,000 Rand trust type, right? So that's something you shouldn't opt for. The difference between inter vivos trust and a testamentary trust. Inter vivos trust means you create it during your lifetime. So it's, for example, I register a trust now and I start moving my assets into a trust. The testamentary trust only gets created upon your death in terms of your will. And then, as I said, the will terms would be used then as your trust instrument terms. So that is the two differences. The one gets registered during your life, the other one upon your death. What were the other ones? A special trust.
Well,
And if you want to go.
Yeah, I think David's question on if there is a donation tax if you donate an asset to a Bewind trust and the same person is the beneficiary of the trust and is the same donor of the trust. Depends on what the trust deed says and what your intention was. If you donate the assets and you dispose of an asset in terms of the Income Tax Act to a trust that is taxed as a separate taxpayer, you have disposed of that asset. The question then arises, David, at what value did you dispose it? Did you dispose it at market value? If no, then you are liable for capital gains tax and donations tax, and not just donations tax. And then it comes back to the question if it was ever declared, what was settled on it, and who will be liable for the income, and if it's vested. So your question is not a simple one to answer, but in short, as with all tax questions, will you pay donations tax? Yes. If you get it wrong, yes. Yeah, sorry, that was just a tax question that I picked up.
Mm-hmm. And on the special trust, if you want to just give it a go, because that's also tax.
Well, a special trust is a trust that's set up for where the beneficiaries are predominantly minors under the age of 21 or handicapped persons. Then they do get taxed at a different rate, and they are taxed as if they are individuals. So they work on a sliding scale, and really those trusts are the trusts, and you can correct me if but those are the trusts that are really run like trusts, where the trustees take their fiduciary duty very seriously. Yeah.
And a lot of people, it could be a similar type of a trust deed that you would have for a normal inter vivos trust. It is a registration with SARS that makes it a special trust. So you have to prove to SARS, that it meets the requirement in terms of the minors or in terms of the disability. So certain processes that you have to follow. So it's a SARS process to label it as a special trust, yes or no.
Yes, quite correct.
Okay. I think we've answered some of them. There's a very interesting one for you from Mr. De Jager. He said, I have a trust registered in Mauritius. However, we effectively manage it from the UAE, and I understand we are now subject to UAE tax law, which is 0% now. If we move effective management to RSA, will we have to pay the 50% withholding tax and remainder in SA in case of profits or beneficiary allocations? That's a mouthful.
I think the overriding principle, as far as South Africa is concerned, the moment a trust is effectively managed in South Africa or it's registered in South Africa, it is a South African taxpayer. So we can get into all sorts of complications, but I think for the rest of the people, I think once you understand that basic rule, the moment you move effective management to South Africa, then you've got a problem from a SARS perspective. So, that's why on all the islands you have your trustee sitting there and you cannot be seen to be part of the effective management. So whether it's registered here or whether it's an international trust that gets managed here, it's within the tax net here.
Just on that effective place of management, remember South Africa follows the OECD guidelines. The effective place of management is not where your trustees exercise and where you have the trustee meetings. It is where the day-to-day decisions of that trust is effectively executed. I'll give you an example. If a trust were to start actively trading in shares, and the trading in those shares are done in South Africa, the effective place of management and the economic activity and reality of that trust is in South Africa. That trust will be taxed in South Africa. So your question as to a UAE trust, I don't particularly mind where your trustees are. The question arises, where's the day-to-day management of that trust being affected from? If you're sitting in SA, you might very well have a problem.
I think that answered it. Thank you, Willem, for that. I'm going to take one or two other questions from David. Is donation tax applicable if a person transfers an asset to a being trust where the same person is the sole beneficiary of the trust? Has there been no change of ownership and so on donation?
Audrey, I think we did answer that one right in the beginning. Yeah. But yes, there will be a donations tax payable if you donate an asset to a trust, even if it's a Bevin trust, as David mentioned. And you'll have to go and look at what the intention was. Does he still de facto own the asset? And what does the trust deed say? It's not. But in principle, if you donate an asset to a trust, there's donations tax payable. Full stop.
Okay. Thank you. Thank you so much, Willem. And then from Ritesh, what is the implications of doing a Section 42 transaction for a trust?
I would assume he's referring to Section 42 of the Income Tax Act. Section 42, for those people listening in on the webinar, Section 42 is an asset for share swap transaction. In other words, you dispose of an asset and you receive an equity share in a company that acquires this asset. There's rollover relief. It was brought in because SARS recognized that these transactions occur and there is no actual cash exchanging hands. So there's a deferral in place. Yes, a trust can do a Section 42 transaction, but then the trust would have had to have owned that asset pre the transaction. If that answers the question. So a trust can be party to a Section 42 transaction. It can dispose of an asset that's owned by the trust in lieu for an equity share. But you cannot reverse it and say that I'm going to give my asset to a trust in terms of Section 42 because, and for a very, very simple reason, a trust does not have equity shares. The only interest that a beneficiary has in a trust other than a vested trust is that you have a hope of a return or an income. It's called a space. Very different from a share.
Fantastic. Panel, I need to end this webinar now. I know that you will both be available. All your contact details are on the presentations that will be made available to everybody. Also the podcast after the webinar. I will have a discussion with the whole team. And on that note, I want to thank the marketing teams, Lutfia and her fantastic ladies, Jade and Alweto, for making this webinar happen. Also for Jason, that made sure that we got our links in time. And for all your support, I really thank you. Thank you to our wonderful panel today, Fia and Willem. You are trustworthy, and I really enjoyed listening to you. We've come a long way, and thank you also for your contributions to BR and personal finance on a weekly basis. Please, audience, feel free to follow Willem and Fia on our various platforms in print and online. So if there's anything else, Willem, if you want to make some closing remarks, or Fia, it's over to you. But from my side, I really want to thank you and also the loyal readers of BR and personal finance. So over to you guys for closing remarks.
Fia, ladies first.
Ladies. Yeah, I always tell people, you're not setting up a trust to be caught later on. So get the basics right, make sure you understand the trust deed, and educate yourself. Don't rely on others. It's been frowned upon by the courts. If you want to be a trustee, make sure you understand, what your responsibilities are, and make sure you've got the documentation, proof of your administration.
Yep.
Thank you, Fia.
I'll say what I always say. Please be careful. Practice safe tax. And never let a tax tail wag a commercial dog.
Well, that's the end of our webinar then. I will definitely inform you of our next. This is the second of a series of webinars hosted by Business Report, BR, and Personal Finance. I want to thank Willem and Thea for their wonderful presentations. It was really very informative, and I'm looking forward to the next one. Take care, stay safe, and in good health. God bless.
Thanks, Audrey.